Good day, everyone. My name is Loto Rose, and this session you're about to have is powered by Bearable FX. Today, we'll be discussing beyond trading analysis in Forex. During this training or this session, we'll be talking about Forex in totality, trading analysis, risk management, trading psychology, 7 key trading nuggets, and what it means to have a trading routine. What this is basically meant to do is to expose us to what comes after doing trading analysis or what Forex is from our perspective in totality. So, as we all know, Forex is foreign exchange, which simply means the exchange of one currency for another. So either you're changing dollar for pounds or pounds for euros or euros for yen and whatnot. That's what Forex is. It has no two definition. It just means the exchange of currencies, full stop. Now, um, the purpose of trading Forex is majorly to make money. Everyone wants to buy or sell um, their currency for another to make an amount of money, some profit, or to buy other things. But when we look at the percentage of purpose, we have a significant number of traders who are involved in Forex simply to make money. Okay. Now, the market is always right. The market, whether the market buys, goes bullish, or it sells and turns bearish, the market is always right. The market is not a person, the market is not an individual. The market is simply a collection of traders who are willing to buy and sell. So the market simply reacts to supply and demand. Here, I made a quote stating that let all traders be wrong and let the market be right. What does this mean? This means that if you do an analysis and the market goes against you, your analysis was wrong. There's no point saying the market is wrong and that you're right or whatever it is. A lot of us do that because it helps our mindset, you understand, which is actually a wrong perspective when it comes to trading. Now, we all know that the market trades over $5 trillion every single day that the market's open. And for the market to trade in value of $5 trillion, it means that there are a lot of other actions, other motives, other mentalities, other buy or sell or cancel trades that occurs from the back end. All right. And all these things, we don't have control over it. The market trades $5 trillion a day. We don't have the $5 trillion. All right. However, there are some components in Forex that we have control over. And to be a successful trader in Forex, you need to understand the components you have control over, focus on those components, and maximize your potentials in those components. And we have 3 components. One, we have the Forex analysis, which has like 5% influence on your success in Forex. You have the Forex risk management, which has like 15% influence on your success, while you now have the Forex psychology, which has a whooping 80% influence on your success in Forex. Now, Forex analysis. Forex analysis is the simplest component in Forex. Forex analysis is the part of Forex which anybody can learn within a span of 5 days to 6 months. And what does Forex analysis simply do? Forex analysis presents you with a checklist, and the checklist is what you use to identify whether a currency pair is going to buy or sell. If it's going to buy or sell, at what point will it buy or sell? Aside from that, it's your analysis that will tell you at what point is your analysis invalid, meaning that your analysis was wrong. Then finally, it tells you what point to take your profits. Now, remember I said Forex analysis is a checklist. What does this mean? It means that you can't just pick one factor. For example, you can't say, okay, I trade support and resistance. So once the market is at a support level, I buy. Once the market is at a resistance level, I sell. If you do that, that's just one checklist. So checklists should be made up of several factors. And over time, experience has taught us that if you have at least 5 different factors you consider before placing a buy or sell trade, it would improve your level of accuracy. So for you to say you have done Forex analysis, your checklist has to tell you whether a market is meant to buy or sell, how much the market is meant to buy or sell, where it's meant to buy or sell from, and if it goes against you, at what point will your analysis be wrong? So, for example, I'll use myself as an example. 1, I use support and resistance. 2, I use candlestick pattern. 3, I use market structure. 4, I use Fibonacci. 5, I use moving averages. These are not just the factors I use, but these are the 5 key factors that are involved in my analysis. So whenever I do my analysis, I try to find out, 1, if the market is going to buy and sell and where the market is going to buy and sell from. 2, if the market goes against me, at what point would there be no return? At what point will my analysis become wrong? At what point will my analysis become invalid? That's my stop loss point. Then 3, it gives me an estimated point where my analysis will be correct up to where I can take profits. Okay, so if you have a Forex analysis system that doesn't tell you whether the market is going to buy or sell, where the market is going to buy or sell from, where you should have your stop loss, and where you should have your take profit, you need to review your trading analysis, because that trading analysis would eventually lead you to blowing your account. I've seen several traders who would do analysis and tell you that the market may buy or sell. Yes, we know the market may buy or sell, but we want you to give us an edge. The reason why you're doing analysis is to be able to identify an edge that, okay, based on my analysis, the market may buy or sell, but my analysis supports the market to buy or sell. And if it's going to buy, it's going to buy at this point to this point. And if it does not buy and it goes against me, after it goes to level X, anything above level X or below level X makes my analysis wrong. So I'll just take my losses there. Now, everybody needs to sit down and come up with a checklist that they will use to trade, because you could have learned so many things from Forex, but there is a way you as an individual relate on a one-on-one basis with all the things you've learned in Forex. So based on this, you use it to design a structure, a trading structure that is easily understood and practical and practicable by yourself. You understand? There's no one way to the market. So I have a friend and a colleague in Forex who uses only 14 SMA, which is the default SMA that comes with MT4. I have a colleague that trades only trend lines. I have a colleague that his key strength is using divergence. So for every trader, you need to identify where your area of strength is and build your checklist around your area of strength, okay? We have what we call high probability trades. So for example, now you have a checklist of 5 factors and you have 2 trade calls. One trade call says that 5 of your factors agree that 5 of your factors are going to buy, while the second trade call agrees that 2 of your factors are saying it's going to buy, 3 of your factors are saying it's going to sell. Now, high probability trade simply means your trade that you have the highest probability of the market moving in your favor. Okay, so if you have a checklist, what you need to do is you need to run different pairs on your checklist and find the checklist with the highest probability to move in your favor. Those are the kind of trades you look out for. So for example, now you're a trend trader, you're a trend line trader or a breakout trader, and you see a trend line that is broken. That trade will probably give you a higher probability than pair a pair or a trade that is currently in the ranging period, because if it's ranging, it's not going to be in line with your checklist. But once it's in line with your checklist, then we'll call those kind of trade high probability trade. Now, there is no holy grail in Forex analysis. There is no system that will give you 100% accuracy in Forex analysis. I repeat, there is no holy grail in Forex analysis. There is no system that would give you 100% accuracy in Forex analysis. For the last time, I repeat, there is no holy grail in Forex analysis. No trading system, no trading analysis system or checklist will give you 100% accuracy in Forex. All right. However, any analysis that gives you above 60% accuracy when tested on 30 trades straight is good enough. What does this mean? So if you take a trade and your trade is 1-to-1, what 1-to-1 means is if you're going to gain $100, you're likely to also lose $100. So that's a 50-50 trade, right? That's a 50% accuracy level. So it means that if you take 10 trades, your checklist or your analysis would give you 6 accurate trades and the other 4 will go against you. So if you have that in 30 trades, that means in 24, that means you got 24 trades correctly, and in 30 trades, 30, 60%, 60% of 30 is 18. So that means you got 18 trades accurately while you missed out 12 trades. All right. So if you take the 12 against the 18, you're still up with +6. Do we understand? So once you have an analysis or a checklist or a trading analysis system that gives you 60% accuracy rates, it is actually good enough. However, you may want to improve it because there are also other trading systems that gives you as high as 85-90% accuracy rates, okay? But the emphasis now is not on trading analysis, okay? We're just explaining that you need to have a system that works. If you have a trading analysis system that gives you 40% accuracy rate, it is not good enough. So you need to improve the accuracy rate of your analysis. All right. So risk management, the secret of consistency. All right. To become a successful trader, you need to be profitable and you need to be consistent. Now, if you have a trading analysis system that gives you 60% accuracy, you are already a profitable trader. But for you to be a consistent trader, you need to focus on the outcome of your trades. Okay? What does it mean to focus on the outcome of your trade? You need to look at what results you're getting for every trade you pair. Okay? And there are 5 different outcomes in Forex. 1, either you have a break-even trade. 2, either you take small losses. 3, either you take small profits. 4, either you take big losses. And 5, either you take big profits. Now I'm going to break these things down. 1, when you have break evens, it simply means you didn't make money from the market and the market didn't make money from you, except from the commission and probably the swap that the broker will take. When you place trades and the trades moves in your favor, some people have made it a strategy that, okay, once the market moves 50 pips in my favor and I'm going to 200 pips profit, I would move my entry to break even. And the reason why they are doing that is because they are protecting their capital. Break even trades are usually used, break even outcomes are usually used to preserve capital. All right. Or maybe you did your analysis and the market went against you, but for some string of luck, the market came back to your break-even point, to your entry point. So you've looked at it that your analysis is wrong, but for one reason or the other, the market has moved in your favor. Some disciplined trader would break even at that point. So when you're going to have break-even outcomes, use it strategically, okay? Don't use break-even out of fear. You need to have a reason for using break even, to break even on your trades, okay? Small losses. All right, so I'm sure we've heard this. This is one of the most popular proverbs or saying in Forex. Cut your losses short and let your profit run. And the truth there is 80% of the time we do opposite of that. While trading Forex, you need to learn how to cut your losses short. So you've done your analysis and the market moves in your favor, but all of a sudden the market reverses against you. The market has not hit your TP, but when you review the analysis, you discover that your analysis has been invalidated. You don't need to wait for it to hit your stop loss. You can always cut your losses short. As a matter of fact, cutting losses short is a way of making more money, because the money you don't cut short, you eventually lose. All right. Taking small profits. Now, taking small profit happens to those who are impulsive. So a market moves in your favor about 100 pips, you don't take profit. All of a sudden, the market drops and it drops to 20 pips, and you're expecting a profit of, say, 200 pips. And it drops to 20 pips, and you're scared. Oh, let this market not move against me. Let this market not take back what it has made. Let me just manage these 20 pips. You take the stop loss. It's actually a bad habit. So each time you cut your profits short, it is most likely 90% most of the time that such traders would let their losses run. So what happens is you're doing the opposite of the saying. You cut your profit short and you let your losses run. So as much as we can, once you do your analysis and you set your trade, you can review the trade from time to time to be sure that everything is still in line, okay? But taking profits prematurely is actually a bad habit of traders, okay? If your analysis was, okay, you've set your trade and your profit is a small profit, you're taking 20 pips profit and your stop loss is, say, 20 pips, it's fantastic. You can do that. It's awesome because that was your trading plan, okay? Now, big losses. Big losses are the reason why most traders are, one, not successful, and two, a lot of traders are boom and bust traders. And when I'm talking about big losses, I'm speaking from experience. I've had an instance where I traded an account and I did almost times 1,000 in profit. And in one day, because I was holding big losses, I lost everything. And that account, I grew the account for a period of 2 months. Do we understand? So you could place trades and set trades, and okay, you start an account with $500 and you're trading the account, and the account keeps growing and the account keeps growing and the account keeps growing, and then you're in losses. But because your mindset is not properly secured and you don't have proper risk management system in place, the market keeps dropping and you keep hoping that the market will go up. Then after some point, you keep praying that the market will get to your break even. Then you start praying that the market will just come up a bit so that you can cut your losses short. And before you know it, you have a margin call. Please, I would encourage you, whatever you're doing, try to make sure that you don't have big losses. Now, big profit. Big profit is the apex of Forex. So you do your analysis, you set your trade, the market is moving in your favor, you review the market and you find out that, oh, the market could go beyond your TP. What do? You remove your TP, take partial profit, and let the trade run. Sometimes what some people just do is they put a trailing profit. So the market moves 200 pips in your favor and your target was 150 pips. You lift your take profit. The market moves 200 pips. You lock it at 150 pips. You let the market run. When the market gets to the position where you're expecting it to get to, say 400 or 500 pips, you take your profit, then you'll be taking big profits. So what happens? If you're able to minimize your big losses or reduce your big losses to small losses, convert your small profit to big profits, you would be a profitable trader, and over time you would become consistent. Okay, consistency has to do with building or developing a habit. So if we focus on improving our outcomes to be more big profits and cutting losses short and strategically using break even, I'm sure we're going to become consistent over time. Okay, to consciously maximize the output of your trade, it is important for a trader to make adequate risk management strategies. Okay, so you need to plan. They said failure to plan is planning to fail. So you need to plan adequately to know how your outcomes are going to pay. Okay, so for example, now you could do your analysis and say, okay, no matter what happens, I'm not going to lose up to 5% of my account. You could say, okay, no matter what happens, I'm not going to lose up to 1% of my account. You could say, okay, whatever happens, I'm going to come, my losses, my SL will not be more than 40 pips. And when the market moves against me 40 pips 3 times a day, I call it quit for that day and I resume 48 hours later. Okay, so this part of risk management is dependent on you. Okay. Proper risk management in Forex ensures maximum profitability with minimum acceptable exposure. What does this mean? So I have a $10,000 account and I say, okay, because I want to do risk management, I don't want to lose my account. I'm trading at 0.01 lot size, a mini micro lot size. At the end of the month, if I make $100, I should be grateful on a $10,000 account. That's underutilizing an account. Okay. So risk management involves taking the adequate exposure for optimum profitability. What does this mean? It means that you strategically focus on one, ensuring that you're getting the optimum profit, and two, ensuring that your risk is at the minimum level acceptable for you. Okay. In doing this, we have things like your risk reward has to be on point. Your risk reward, for example, an okay risk reward level ratio would be 1-to-1, which means that if you gain $50, you would lose $50. Some do 1 to 1.5, some do 1 to 2, some do 1 to 3. 1 to 3 and above is fantastic, which means that if you're going to lose $50, if the market goes in your way, you would make $150. Remember, we've spoken about accuracy level, and your accuracy level has to be above 60%. So if your accuracy level is above 60%, and for every accurate trade, you're making ×3 on every trade that you lose, I'm sure your profit is going to be at an exponential level. Okay. Now, risk management strategies should involve risk strategies that you can relate with. Okay. There is no one way to the market. So you yourself have to sit down, review one, your accuracy, the accuracy of your analysis, two, your risk reward ratio, three, the acceptable exposure level per trade. And all these things would be used to formulate your risk strategy. So for example, let me give you a brief example of what I'm trying to explain here. So me as a trader, or I as a trader, one, my accuracy level is around 60% on 30 trades straight. And sometimes it could be above, it could be more, as much as 80%. So I'm good there. My risk reward ratio minimum is 1 to 2.5. So for every trade where I lose $50, I am going to be making $250. No. For every trade I'm losing $100, I'm going to be making $250. Let me use that as an example. So for every trade I may lose $100, I'll make $250. So I like looking for trades where the risk to reward ratio is 2.5 and above. Sometimes I find some trades that could give me as much as 6, 7 as my risk to reward ratio. Now, my exposure level, I try to make sure that I do not lose more than 3% of my capital in a day, and that's me being aggressive. So for me to lose 3% in a day, I make sure that one, if I take one trade and my exposure level, that's my entry level to my stop loss level, is about 3% of my capital, I don't take any other trade for that day. Sometimes I could take a trade for the day and my exposure level is 0.5%. So in those kind of days, I could take as much as 6 trades. All right. So finally, for your risk management, it has to be unique and it has to be defined before taking a trade. I give an example. Trader X has $1,000 in his trading wallet. He funds his trading account with $200 and takes 100% risk on a trade, which means that if the trade hits stop loss, he will lose the whole $200. But if the trade moves in his favor, let's say his favor is his risk reward ratio is 2 or 2.5. So for that trade, he's going to be making like $500 or $400. Okay. Trader Y has $1,000 in his trading wallet. He funds his account with $1,000 and he takes a trade with an exposure of 10% risk. He would also lose the same 200. Then whatever he gains on it may be dependent on his risk reward ratio. Likewise, trader Z has $1,000 in his trading wallet. He funds his trading account with $1,000 and takes 5 trades with a risk exposure of 2% per trade, which brings us to a combined risk exposure of 10%, which is also the same $200, and whatever his risk reward level is will determine as well. Now, these are different trading strategies, and each trading strategy is dependent on one, the individual trading and the purpose of taking those trades, or the character of the person and the uniqueness of the trade. Okay, so never should you at any point become unaware of what you may likely lose. As a matter of fact, to start becoming a consistent trader, you need to change your mindset from what you stand to gain by placing that trade, that buy or sell trade, and focus more on what you may lose by clicking on buy or sell for that trade. So if you look at your trades and you say that, okay, if I take this trade, I may lose up to half of my account. Even if the trade is 100% accurate and it's a high probability trade, you may need to reduce your lot size. And in a situation where you can't reduce your lot size, you may need to forgo that trade so that you don't lose up to half of your account. Okay, so please, you need to go back, do your homework, and learn more on risk management so that you can apply it to yourself. There are some traders who set their trades in the morning and they are not bothered because they understand that by the time they come home, even if the market will move against them, they can't lose more than 5% or 1% of their account. However, if the market moves in their favor, they know they are coming on to maybe 3% or 10% increase in their account. So that makes them a steady trader. They are not moved by impulse, they are not moved by emotion, and their focus is top notch. Okay? Now we move to trading psychology, the place of battle. Everything in Forex starts and ends in the mind. Okay? So every trader has a mindset when they're about to enter the market. And the mindset has to be top notch. The mindset has to be right so that one can benefit and optimize the opportunities the market presents to the person. Okay. So 80% of trading Forex is a battle of the mind. If you do not conquer Forex in your mind, you cannot conquer Forex on the trading platform. Okay. So you're trading against the market. Nobody is taking your money from you, even though we understand that people have said it that Forex is a zero-sum game, which means that for one person to be gaining, another person has to be losing. I'm not a party to this, but this is a norm that we all have accepted. Okay, so this is you dealing with yourself directly. If you expose yourself too much, it is your fault because you did it on your own. If you do not use the right checklist, it is your fault because you did it on your own. If you have your trading system and you abandon it to trade impulsively, it is not the system, it is not the market, it is your fault. So when trading Forex, you're basically trading against yourself. Okay, if you're a greedy person, if you're a timid person, if you're undisciplined, if you're afraid, if you're incompetent, if you're impatient, it would reflect in your trades. So once it shows in your trade, it will show in how bad you've been trading. It's very simple. You can spool your report for the last 3 months and review it. You will notice either at some point you closed profit when you're not supposed to close profit, or at some point you removed your SL because you didn't want to lose money, or at some point the market got to your take profit point and you did not take profit because you are hoping that you are going to scoop all the profit from the market and the market has now reversed against you, or you do not even know what you're doing in Forex. You just wake up early in the morning and because the breeze is blowing from the north to the south, you decide to buy. And if the breeze blows vice versa from the south to the north, you decide to sell. That's you being incompetent. All these things are going to show in your habits. They are going to show in your trading history. And your ability to identify these things and work on them mentally would improve your trading career, would improve your trading success. Okay, to be profitable and to be consistent, you need to win the battle in your mind. There is no king that goes to war with the mindset that he's going to lose that war. Every king that goes to war has the mindset that they are going to win their opponents. Okay, however, there are some times that a king may lose some battles to strategically win the war. This is where break-even comes in. So sometimes you've taken some trades and the trade is not going in your favor. You may need to break even or cut your losses short so that at the overall end, you would have more wins than losses. Okay? Your skills and your knowledge, what you know about Forex analysis and your knowledge on risk management may make you profitable. But who you are in Forex, your characteristic in Forex, your personality in Forex, understanding it and optimizing it would keep you profitable in Forex. And keeping yourself profitable in Forex is what makes you a consistent trader. And a successful trader is made up of a consistent and profitable trader. Okay? It is very, very important to understand trading psychology, learn about trading psychology, apply trading psychology to yourself, as you may have a holy grail in analysis, which by the way does not exist, have proper risk management strategy, and because your psychology is not top notch, not on point, not refined, you may still lose that account before the end of the week. Okay? So trading psychology gives you the right mindset and helps you make the right decisions while trading. Your trading analysis and risk management will help you develop a system, but it's your psychology that will help you stick to that system. So your knowledge will tell you, okay, I'm going to use supply and demand, and this is how I'm going to use supply and demand. If I see a divergence with a candlestick pattern, I'm going to buy and sell to this point, and my stop loss is going to be at this point, and my take profit will be at this point. Applying Fibonacci, I'm expecting a pullback to this point with my stop loss at this point and my profit at this point. Then your risk management will tell you, okay, since this is my exposure, this is the amount of risk size I'm meant to use. I'm going to take just 5 trades per day. I can take trades of about 19 in a day, since I know that in totality, I'm not going to be exposed more than 5% of my account. After you've gotten all that in place, if you do not have the right mindset, you may find yourself buying instead of selling. Then after the end of the trade, or after you've lost all your money, you now be asking yourself, since I did my analysis to buy, why did I sell? And the reason why you sold is because you didn't have the right mindset Okay, so you need to work on your mindset. You need to use your mindset to stick to your system. You need your mindset to maintain and use that system that you've developed. Okay, having the right mindset is the most difficult component to acquire in Forex. However, once you acquire it, you move from a loss or gambling trader, from a boom and bust or struggling trader, to become a consistent, profitable, and successful trader. Okay? Now, I said it earlier, in trading analysis, you need to work with things that you can relate with. Risk management, you need to work with things you can relate with. Trading psychology has to be with things you can relate to. It has to be things you understand. It has to be things you can easily follow. Okay. There is no perfect trading psychology. However, you could read and learn more and watch videos on seminars about trading psychology so that it could help shape your own trading mindset in the right form to make you a successful and consistent trader. Okay. These are my 7 key trading nuggets. These things form a foundation for me when it comes to Forex. 1, there is no holy grail in trading Forex. All system would fail at some point. Your ability to minimize your loss and maximize your profit is what makes you a consistent and successful trader. Okay? You need to have a well-defined system before you start trading. Because if you're trading without a well-defined system, you're just gambling. I've heard so many things in Forex. For example, some people say when the moon is full, the trend is going to change. So they look out for full moon. And if the market was buying before, they switch to sell. Now, I'm not saying it's not working for them because in truth, when you're trading analysis, it could be anything. But you need to have a defined system that would answer all the important questions in Forex. Where to buy or sell? What is your invalidation point? What is your take profit point? How often should you trade? What are the things to look for before you trade? How much should you be exposed? How much risk should you take? What lot size of trade should you take based on your capital? Once you're able to answer all these key questions with your trading system, then you have a well-defined trading system. Understand, trading is not a business of luck or chance. Rather, it is a well-structured financial system. Okay? Even though you're going to have a well-defined trading system, you need to keep your system simple and stupid. What does it mean? It means that your trading system should be something that if you put in front of someone today and the person follows your system to the letter, the person will be consistent and profitable. It doesn't mean it has to be comprehensive and difficult to understand. It has to be something that people can easily understand and work with. And the reason why it's important for it to be understood and easily understood and easy to use is because you need to reduce your emotions and let it be more mechanical or logical so that the system will work on its own. The days you take losses, your losses will be short. The days you're in profit, your profit will be long. Okay. Now, Forex or trading is not a sprint. It's not something you do for a short term. It has to become a lifestyle. And I'll tell you this, since I started trading full time or I started trading properly prior to 2017, I was doing more of gambling. So if someone says buy, I buy. If someone says sell, I sell. If I go online, I go to TradingView, I look at ideas. I say, okay, 5 people say they want to sell and 3 people say they want to buy. Without considering the reason why they're buying or selling, I follow the majority. All right. So that was gambling. I started having a trading system after going through a training in December 2017. And since then, my life has changed. Trading has become a part of me. Everybody that knows me with Forex, because in everything I do and everything I say and everything I see some form of Forex or trading taking place. Okay. Trading has to be a way of life. It has to be a lifestyle. It's not something you do just to get out of debt. It's not like you have $50,000 and you need 5 million, so you go into the casino and try to double your fund. No, that's not what Forex is. Okay. Thirdly, for you to become consistent, you need to apply the 90-90-90 rule. And the 90-90-90 rule says that 90% of traders lose 90% of their capital within 90 days. So for you to become, first, you need to work on your analysis to become a profitable system. Now, after you have a profitable system, you need to use this 90-90-90 strategy to develop yourself to become consistent. What does this mean? Fund your account with a minimum balance, say $100 or $500. Trade that account for 90 days and make sure you don't lose 90% of whatever startup capital you use. If you're able to do this continuously, do it every 3 months. Shortly, in no time, you would find out that you've developed a habit that has made you consistent in one, not blowing your capital, and two, you would start making profit if you keep trading along with your trading system. Okay? Trading has more to do with our individuality than anything else. There are millions and millions of traders globally, and no two traders are the same. Okay? So you need to discover who you are in Forex. I could have a system that works for me. I could have a risk management system I use. I would have a trading mentality that I have. But you need to develop something that suits you as a person, something that works for you, something that you can relate with. So that when you're trading, you understand that you're trading on your own by yourself, with yourself. You understand? So you need to find yourself in Forex. What type of person are you? So I have a trading colleague who understands that he has poor risk management skills and his mentality cannot help him in that aspect. So what he does is he funds his account with $200, which is the risk he's willing to accept. So he places trade on $200. If the trade goes against him, he loses $200. If the trade moves in his favor, he could make as much as $500, $600, $800. And this guy has been consistent because he grew to understand himself and he was able to work his way around his risk management, his psychology, and his analysis. Okay, so the ball is in your court. You need to find out what Forex analysis you're cool with. You need to find out what risk management strategies work for you. You need to find out what psychology or mentality you need as your individual to become successful. Okay? In Forex, you need to focus on things you can influence and ignore everything else. So I see people talking about news, that okay, once the news is going to move like this, and okay, I'm going to buy with the hope that when I buy, my buy is going to influence the market to move up. The market doesn't work like that. Focus on the Forex components, the things you can influence, the things you have the power to change. Sometimes they say it's good not to click the buy or sell button, because if you do that, you're saving yourself money, because if the market goes against you, you've lost money. So you not taking that trade is a way of you saving yourself money. But are we now going to say out of fear we should not take any trade? No. So what you do is you focus on your trading analysis, you focus on your risk management, and you focus on your mentality to make sure that you're able to make optimum profitability as you trade Forex. So I go to the last section, which has to do with the trading routine. The trading routine helps you to develop step-by-step activities from conception of being involved in Forex that day or that period till the trade is finally closed. Most successful traders have trading routines. So when we talk about trading routines, it talks about the things you need to do before you place a buy or sell. When you place a buy or sell and you're in the trade, the things you need to do while the trade is ongoing. And when the trade eventually closes, the things you need to do to make sure that you improve and you become a better trader with each passing day. So for pre-trading routine, you need to run the currency pairs of interest through your analysis checklist. Now, the reason why we're doing that is to find high probability trade calls. Once you're able to do that, you need to identify your stop loss levels and your take profit levels. Now, I'll give you an example. If you have two trades, one says your stop loss is 50 pips, but your take profit is 30 pips. And we have another trade that is vice versa, which means your stop loss is 30 pips and your take profit is 50 pips. It is only logical for you to abandon the trade where the stop loss is more than the take profit and focus on the trade where the take profit is higher than the stop loss. So you need to understand how much you stand to lose and how much you stand to gain. It doesn't make sense to lose more than you are willing to gain. So 2 weeks ago, a friend invited me to a channel, and on that channel, I discovered that the trader was always going for 20 pips profit, and his loss was 70 pips. And at some point, I had to excuse myself from that channel because it did not make sense. So if you have 5 trades and 3 hit take profit and 2 hit stop loss, you would have lost 140 pips to gain 60 pips, which means that you are in a net loss of minus 80 pips. That is not logical. So these are the kind of things that would help you sift and identify what trade you should take. So after you've done this, you now look for the highest probability trade with good risk to reward ratio. So you have 2 trades. One is, as I've said, your profit to loss is lower, but the other one, your profit is higher. You take that one as long as it's a high probability trade. Okay, then after you determine your trades that you're going to take, you now need to confirm how much risk you are willing to take for that trade. So for example, now your stop loss is 100 pips and you only want to lose $50. Your maximum loss you want to take is $50. Automatically, you take that $50 and you divide it by 100 pips, which gives you 0.5. So $0.5 per lot size or per tick should be what you'll be looking out for. So in Forex, that will give you a 0.05 lot size, a 0.05 lot size to use for that trade. So if the trade goes against you and it hits your stop loss at 100 pips, you lose $50. But if it goes in your favor, let's say in your favor it moves 300 pips, you make $150. So those are the kind of things you look for. Now, if your analysis is wrong, what do you do? Most times than often, a lot of people have big losses because when the market goes against them and it gets to their point of invalidation, they freeze. They don't know what to do. They don't know whether they should end the trade or they should add to that trade. So what most people do most of the time is they take the stop loss, okay? But for you as a trader, you need to look at your analysis and say, okay, if I am wrong here, what will I do? Let me take the stop loss here. And once I take the stop loss here, I'll move the profit to this point. Then we'll continue from there. So you have to determine and decide what countermeasures, what counter strategies you're going to take for every trade that moves against you so that you will never be caught unawares. Okay? Take note of trading 1 to 5, then wait for confirmation or the opportunity to place the trade and take the trade. Now, during the trading routine, what you do is you take all the trades when there's the confirmation that you've already planned before or the opportunity that you're looking out for is set. If the opportunities are not available, you sit on your hands and do nothing. You set the planned stop loss and take profit as previously planned in your pre-routine. You do not say, oh, okay, so now the market is moving. I know the market can be funny. I know there is news. You know, Donald Trump is about to tweet something, so the market may go against. Set your stop loss. Don't give yourself an excuse. If you've already planned for stop loss, set your stop loss. Let the market hit your stop loss and leave and take you out of the market. It is better for you to cut your losses short than for you to get to a point where there's no point of return. Okay? Observe the market's dynamism. Most of the time, we do analysis before the market opens. And after the market opens, then the market now starts taking some new forms and shapes. It is our job to identify those new forms and shapes and apply it to ourselves. So if we see a new form and shape and the market is not moving in our favor, the next thing we do is we observe and cut the losses short. Okay? If the market is not moving in our favor and the market is coming down, we're looking at it that, okay, the market may drop. Sometimes it is better to close at break-even point. Aside from that, if the market is running and the market is moving sporadically and you know that is probably going to break through your take profit point, you can remove your take profit and apply trailing stop. So you've already made your plans. Now you're in the trades. You're looking at the market and you've applied further analysis and you say that, okay, the market is not going to move as planned. You make adjustments in your favor. You make adjustments to favor yourself. You lock your trades, lock some profits, cut your losses short, close the trade at break even, wait for a lower low to enter or a higher high to sell, then remove your take profit and let the market run. If the market has shown signs that it's still going to continue in your favor, okay, please, I beg you, in the name of God, do not do anything that was not planned previously during the pre-trading season or session, because this may jeopardize your trading account. It usually would. So you've done your analysis and someone says, oh, have you checked this trade? This trade is going to buy. Don't go to that trade and buy. Or you now look at the market, you now say, oh, you've done your analysis. You say, okay, I'm going to use 0.05. You now say, but this analysis, if this market just moves in my favor, the profit will be mad. Okay, you know what? Instead of me using 0.05, let me use 0.5. Do not do things like that, because most times, often than not, you get your account burnt. Okay? Post-trading routine. You need to take time to review your trades at the close of every trading day. Learn from your good trades. Learn things to do better. Learn from your bad trades. Learn the things you could have done right. Learn the things you should have done that you did not do, and the things you did that you should not have done. Okay? Then use the information obtained from the trading review to determine the next thing about you need to work on. So, Forex is a structured market, and Forex has a process. You do not become successful in Forex by chance. Hell, there is nothing in life that you become successful in by chance. You don't get lucky to become a successful person. So you need to apply yourself. If you notice that, okay, your greed is getting a lot of you while trading, you need to work on that. If you find out that you lack confidence, you need to work on that. So you need to pick from your analysis, you'll be able to identify your weak points, and you pick those weak points and consciously work on them. Then finally, you prepare for the next trading session. Okay. So now we've come to the end of this training or workshop or seminar or session. I'd like to thank you for taking time to listen to it. Once again, we appreciate Bearable FX for powering this event. And if you have any questions, you could always send me a message at Lotto Rules on Telegram. Thank you very much, and till the next time we meet again.